The Fed hits the pause button. The Fed announced a rate hike pause and the market rejoiced. Wait, you're telling me the Dow Industrials sold off over 255 points on the news that everyone already anticipated? What gives? The Fed agreed to hold off on raising the federal funds rate in June, but they announced that 2 additional 25 basis point hikes might be needed by the end of this year. This is just a breather while we wait and see if core inflation can head lower with further intervention. Looking at a 5-minute chart of the S&P 500 ETF, SPY, you can see that the market didn't initially respond well to the news, but gained traction through the end of the day, especially finishing strong with increased volume over the last 10 minutes of the trading day. The Nasdaq 100, QQQ, had no issue with the news. The sector continues to run higher. Much like the Fed, the S&P 500 is taking a breather and closed flat. Although we just finished one earnings season, it's important to note that the part of the inflated revenues that helped companies beat earnings expectations came from inflation. While companies were reporting record revenues, their profit margins were slimming due to the high cost of workers and falling corporate real estate prices. If margins were slim when revenues were high on inflated dollars, we should be looking out for what happens during the next earnings season when inflation subsides. I think we'll see margin compression, and I don't believe that is priced into the markets. Until then, the market is in risk-on mode, but be cautious at these levels. The CNN Fear and Greed Index is pointing to extreme greed, a level that usually indicates a pivot is coming. The S&P 500 is also at a cycle high where we'd expect to see a pullback. I'm looking for a 3% dip to $425. Today's trade is using ASML Holding, ASML. It's a semiconductor company with a history of rising earnings per share and sales growth. It's been in an upward trend with the other artificial intelligence companies, and I see a support level of around $710. Now, I can go out to July and buy a call option, but the 21st of July $750 call, which is out of the money, would cost me $2,550 per contract. I can go over to the put side and create a bull put spread by selling the $710 put while buying the $700 put for protection in case the stock heads lower. The market isn't open, so these prices may change, but I'm seeing a credit of $310 on a $700 investment. I may not be able to get filled at $3.10, but as long as I collect over $2 on a $10 wide spread, I still have the potential to make a 20% return on risk in 37 days. If you have any questions, comments, or anything we can help with, reach us at any time. Any trade or trade idea discussed is for educational purposes only. For more information on this trade idea and others like it, visit tradersreserve.com.